Hello, and I welcome you to today's Admiral Markets weekly market outlook here on the 8th of March 2019. This is Jens Klatt speaking, and I'm presenting you, or I am here for you for the upcoming 45 minutes as your moderator of the input here regarding the markets, what happened, what will happen probably today, thanks to the non-farm payrolls. So usually we have the U.S. employment situation on the 1st of February, first every Friday each month, though, that way. Today it's the second, but nevertheless, here today it's a special Friday then with the non-farm payrolls. Yesterday we had the ECB rate decision here, resulting in a sharp drop in the euro. On a broad front, making new yearly lows in the Euro USD, for example, dropping below 112, currently stabilizing slightly above that level. To me, surprising, but on the other hand, I have to say probably this is also giving a quite clear feedback of what market participants currently what level of trust the market participants have in the ECB. I think this probably crashed yesterday, probably at least dropped significantly. Before we start, nevertheless, we want to have a look first here at the risk disclaimer. And then have a look at everything else here, what we want to look at here today, what we can do out of the price action from yesterday. So trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. For example, the kit, the key information documents available on the website from Admiral Markets. If you have further questions, please reach out to the service of Admiral Markets. Here, another risk disclaimer. Since August 2018, we have now differentiation between retail clients and professional clients. And this is something we want to have a deeper look in, something we know as the so-called ESMA decision. There's now a leverage restriction for retail clients with a max leverage of 1 to 30 in Forex majors, like EURUSD, for example, but also a max leverage here in other currency pairs, so-called minor currency pairs, like, for example, CAT JPY of 1 to 20, and also a max leverage of 1 to 20 in CFDs on indices like the German 30 or the DAX 30 in case of Admiral Markets, and gold. And so the interesting thing is that Admiral Markets offers something really special also for professional clients. If you apply for professional client status, you have to meet certain criteria to be ranked as a professional or categorized as a professional trader. And then you do not have a leverage restriction. But there's one thing that especially retail clients really like about the ESMA decision. It is that they have an unlimited balance, negative balance protection here. And this is also true in case of Admiral Markets for professional clients, which have such a negative balance protection up to £50,000 according to the policy. Further information, please feel free to reach out to Admiral Markets directly. This is me, the voice or the face to the voice you're currently listening to. I'm located in Berlin, Germany, and so here in Germany, we refer to Admiral Markets as the so-called DAX expert. So when talking to or about CFD trading and especially DAX trading, you're very quick mentioning Admiral Markets over here in Germany. And this has something to do with one of the best index offerings in the CFD era here among all brokers when it comes to the typical spreads. No additional commission, for example. Typical spread of 0.8 points. And also further information, please feel free to reach out to Admiral Markets directly. There's also another offering on top of that, the so-called Admiral Prime offering. This is especially interesting, in my opinion, for FX traders with very, very competitive conditions of FX pairs here. Everything around this topic available on the website. Here, is the presence of Admiral Markets. So I'm located in Berlin, here in Germany. So Admiral Markets also has an office here in Berlin, Germany. And nevertheless, there's also other offices around the globe. Not only in England, where Admiral is, for example, registered, not only registered, but also authorized and regulated by the Financial Conduct Authority, the FCA, for example, but also, for example, in Australia, Admiral Markets Pty Limited, for example. Also here on all regulations and what this could mean for potential clients, feel free to reach out to the website from Admiral Markets, admiralmarkets.com. Here are the contact details. So if you are interested in the services of Admiral, feel free to reach out to Admiral directly. And now we want to have a look here at our agenda today. The questions we want to answer. So first of all, what are the key economic events in the coming trading week? I'm not sure if the economic calendar is really that important. After, especially yesterday and after the ECB, the main focus now is, again, strongly on the central banks around the globe. And to be honest, when looking at the rhetoric and the obvious, it's not an attempt, or probably it's also an attempt to really down talk the euro. It's becoming obvious that we are now again in a state of race to the bottom, and where the weakest currency is the most appreciated ones. And this is especially true then when it comes to the US dollar and the knowledge around the White House, Donald Trump, the knowledge that he wants a weaker US dollar. So it wouldn't come as a surprise if especially the White House, not necessarily Trump himself, but probably his chief economic advisor, Kudlow, or the US Treasury Mnuchin, for example, one of these persons that they aggressively start to somehow down talk the US dollar, the greenback here, which could cause some volatility in the markets. Same is true for the trade talks, surely. So not necessarily true that the economic events next week will cause significant volatility, but nevertheless, we want to have a look at the economic calendar here on the website from Admiral. And then start from there. Then, sure, we want to answer the question, what's the current bias in the FX, equity, and commodity markets? And also, finally, which trading opportunities may arise? And so with this in mind, we switch over here to the charts, and then we have a look directly to Euro USD. So let's probably start. Let me just have a look here whether I have this prepared, and I have. Great. So these are, or this is the key of the decision from yesterday, in fact, which in fact did not come as a big surprise. So there's no change in the interest rates from the ECB. Main refinancing rate stays at 0. The marginal lending facility stays at 0.25. And the deposit facility rate stays as minus 0.4%. So no change here. What's of higher interest is surely that the ECB came out with a series of new targeted longer-term loans, so-called TLTROs. This is long-term, or LTRO stands for long-term refinancing operation, and the T right at the beginning is targeted. So it's targeted cheap liquidity provided from the ECB to banks, which banks then hopefully use, or not hopefully, but which is then demanded from the private sector to somehow get the credit growth going, let's say, respectively, that it hopefully results in the European economy taking on momentum then. Problem with this is that these TOs or TLTROs, this is not the first time, but it's the third time, in fact, that the ECB delivers exactly that. And the problem with these TLTROs is, what shall we say? It just does not get the job done, to be honest. And this is something which is of high interest because, and therefore, I'd like to show you something else. I haven't prepared it, unfortunately, but 1 second, I'll have it in no time here. So I think this chart, and I came across this in the morning coincidentally, to be honest. So it was pure coincidence that I saw this chart, but it perfectly illustrates of what impact those QE respectively on how dependent markets are currently on the liquidity from the ECB. So what we can see here is that here German 2 and 10-year curve, that it was very, very flat at the beginning of QE. That was here in 2015. It was very, very, very flat. And then, not necessarily due to a rising yield here at the longer end at 10 years, but it was more like a push lower, aggressive push lower in the short-term leg and 2-year in the negative territory, that it steepened then. And when we ended the QE program, that was here, it was the beginning of 2019, January, the yield curve here flattened aggressively again. So to make long things short, it does nothing more than the ECB inflated the balance sheet to 2.6 trillion. And the moment it stopped buying bonds here in this QE program, growth and inflation expectation just plunged. And this is a perfect example of the problem the ECB currently has. Cheap liquidity is not getting the job done. So there's no real trust in the European economy in general, in European politics. And on top of that, and there was also something, not sure, does this chart? No, unfortunately it doesn't. But let me just have a look here. I know that here, he had a chart, but I'm not sure whether we will find it now. He had a chart over the last days which perfectly illustrated that the TLTROs didn't work over the last times, and this won't change this time too, to be honest. So chances are really, really high that these TLTROs won't get the job done again. So you can see, if you want to follow someone who has plenty of Bloomberg charts here with lots of, and there we have it, with lots of fundamental informations, feel free to follow. In this case, his name is Schuldensühner. It's Holger Czepitz. He's a journalist from Welt. This is a quite big newspaper here in Germany, and they are also, the main location is here in Berlin, and I know him personally, so I can highly recommend following him. This is really, really a deep and very good stuff here to look at. And yeah, so what do we have here? What we can see, and this is the tweet here at the bottom. So the ECB has failed to spur credit growth with long-term funding programs. That was a chart already published here on the 3rd of March. That was last weekend, I think. I called TLTROs, and it looks as if banks in Italy and Spain especially did not use the cheap money from ECB to issue loans, but rather to engage in freaky carry trades. And credit growth in Spain and Italy also remains negative. So the thing is, and this is something to remind ourselves of, especially when looking at the performance yesterday in equities, especially in the DAX. So some of you might be irritated of what just happened here. When looking at the hourly chart, you can perfectly see it. Usually you get more liquidity or cheap liquidity, and what you usually expect is equities to gain. They didn't. In fact, the DAX sold off sharply. So this is the candle here followed or which initiated then bearish momentum into the evening here. In the 5-minute chart, you can see it even better. So that was not only the ECB, but also when looking at the US equity markets, they couldn't really take on momentum here. And this, at first glance, it comes as a surprise, because usually, again, you expect markets, especially equities, to take off once more liquidity is delivered, cheap liquidity. This didn't happen. So why is that? And I haven't prepared the chart. I won't open it right now, but look at Deutsche Bank, for example, yourself, the equity price. It's not that we are not already for quite a bit now in a downtrend, but yesterday Deutsche Bank was one of the worst performers, and this has to do with the fact that their whole business model with low yields is completely destroyed, and with the outlook that there won't be a rate hike in 2019. This is something which became obvious yesterday too. So swap markets currently price in a chance of a rate hike from the ECB here from, I think, September 2020 onwards. The thing is that they won't take on any momentum, and they won't. There are really no hopes that they will make good money sooner rather than later, hopefully, because and why do they need this? Well, because they already have a so-called cost-income ratio here of something like 100%. That means nothing more than they have to spend €1 to earn €1, which is a catastrophe for a bank in this case. And then their business model is destroyed due to the low yields. And so what I refer to is they need other sources of income somehow to generate it. So it is very, very unlikely that those, even though they are targeted long-term refinancing operations, which means usually they are not allowed to be taken as a vehicle for carry trades or something, but nevertheless, the banks somehow have to make money to survive in the current low-yield environment. And so this is another factor which is becoming obvious that these TLTROs just won't get the job done to spur credit growth here. So to make long things short, the situation in the euro here and the drop lower due to the fact that especially the ECB made the impression to somehow lose control. So for example, yesterday there was also a statement from Mario Draghi, a quote, where he said that negative yields here worked quite successful. Not sure at which currency he's looking at here, but he's obviously not referring to the euro or the eurozone in general, because we can clearly see that negative yields did not work. In fact, it completely destroyed nearly the banking sector. Look at the European banking sector, not only at Deutsche Bank. You can also look at it from a broader perspective. You will see that yesterday the banking sector collapsed after the ECB for good reason. So with this in mind, it's obvious that obviously the monetary policy does not work, and it seems as if the ECB does not have a plan to get credit growth growing, to get the economic outlook to brighten, to somehow spur inflation. So there's no real plan how to get the job done in terms of economic growth. So with this in mind, the drop in the euro is probably more likely a result out of the fact that the ECB seems to lose control. It's not necessarily the case that it's a very dovish stance. This has to do with the fact that this was already priced in. So I expected these steps already to be taken yesterday, as did many other market participants. And usually this is then most of the time resulting in a so-called sell the rumors and buy the facts. So usually you expect the euro to gain then. In fact, it drops, which is a clear sign of mistrust in the ECB. And the same is true when looking at the DAX then. Again, usually you expect equities to gain. In fact, they don't gain, but they drop sharply. So far, the overall bullish technical picture in the hourly chart is not negated as long as we trade above this green line here, which you can find around 11,390 to 11,400 points. So we are currently only short of to see a quite significant attack at this level. Nevertheless, so far we are still trading above that, and the overall bullish mode is still in play. But if US equities today come in weaker and we break below 11,400, further losses, first target around 11,250 points seem very likely, and it seems to increase the chances of a quite deep red weekly close then. Most of this also, by the way, relies on what we get to see around the non-farm payrolls. But first things first, let's have a look here at the daily chart in the DAX, and then come back to the non-farm payrolls, the most likely impact on the Euro USD, and then come back to the DAX. So just switch here between those markets. So if we drop below 11,400, and by the way, we also have to remember, yes, we made a quite significant push higher from the 2018 and December lows here over the last 3 months. Even though from a pure technical perspective, the picture hasn't brightened significantly, but in fact, it makes the impression of a potential bear market rally. And if now not the ECB is capable of really giving the market the push it needs to at least push back towards. We are not even talking about making it back above significantly or sustainably above the purple line, which is the 200 moving average, simple moving average here. This is a clear sign of weakness, in my opinion, and especially if we drop now below the short-term relevant level at 11,400 points, chances seem high that in the days to come we'll go down to minimum 11,000 points, probably even lower than that. This is especially true, by the way. It could be driven by U.S. equity markets. There's another thing we have to remember. The trade talks between U.S. and China, well, let's put it that way. Donald Trump says they are going well, but and this is not only Trump, but also several newspapers, they say over and over and over again for 3-4 months now that they're going well, which is usually a sign that they're not going well at all. This is at least something you could come, the conclusion you could probably come to when looking at the same headline for months and over again. And even if they're going well, and even if this was one of the drivers higher for U.S. equities here, and it was surely not only the Fed, but also the comments from the White House. Plunge protection was brought into play at the end of December, all this. So these gains here, they were probably also driven by the speculations around the solution between the US and China. And that said, this is completely priced in. So if we now get a deal presented whenever in the near future, it is we should doubt that this will give the markets another push, significant push higher. And even if we get one, it's probably a short-lived rally, a last leg higher, into which we should favor short positions and sell into instead of buy into, because it's, again, nearly priced in, completely fully priced in. And this is also something we have to remember in terms of the DAX. So the DAX can take on bullish momentum on a dovish ECB or a dovish interpreted ECB. And she was really dovish, to be honest, when looking at the TLTROs and looking at all those steps they're willing to take now. So the DAX can take on bullish momentum. It can profit from a weak euro. And now those trade talks are also fully priced in, which means, or the result of such trade talks, and we're not even mentioning that these trade talks probably fail. This is also an option we should keep in mind, and which is probably not the highest probability, but still one we should have on the agenda. All this is definitely negative for the DAX, so I don't really see why we shouldn't go at least for a retest of 11,000 points. And all this combined means I definitely favor short-term short engagements, especially from an intraday perspective. So I think the risk reward for the short side seems to be favored. This completely changes surely if I'm completely wrong and we make it back above 11,700 points, then yeah, sure, then there's further gains to be expected, and probably we can also make it up to 12,000 points. But right now, below 11,700, I think the short side is definitely to be favored. The same is true for Euro USD. So here I have to say that today's non-farm payrolls, by the way, which are expected to come in at 180,000, while the main focus is most likely to be on the average hourly earnings, they are expected a month on month on 0.3%. Every disappointment here is probably resulting in a short-lived rally on the upside in Euro USD, probably making back at least some of the losses from yesterday. And probably this will save the euro from a weekly close below 112. But to be honest, even these rallies, I favor to sell them and consider the region around here, the former yearly lows. These were the lows from February, which we broke below yesterday. That's around 112.30, 112.40, something like this. So this is a region against which I could imagine short engagements to be of interest. And what you can already see here is I duplicated a range because it's really difficult to find a potential target on the downside due to the fact that the last time we traded here in this region, that has been in June 2017, which means it's really difficult to say this is a relevant level or something. But what you can do in such a case is, especially after the market here has stabilized over quite a while now, so we're talking about months of stabilization from November 2018 onwards, if you want, so it's nearly half a year, and the market here built out a range where he found support around 112 and resistance on the upside around 115. So the range is around 300 pips. And what you usually do then is you just duplicate the range, which I did here, and then you come out around 1.9, 1.10 as a first potential target on the downside. So from a purely technical perspective, and if Euro USD keeps on building momentum here on the downside, this, by the way, also a potential given and once non-farm payrolls surprise on the upside today, even though I'm not really sure if this would be a sustainable move here. I'm not really sure whether this would really result in US dollar gains, but more likely US dollar would profit here from the current weakness in the euro mainly, but whatever the reason is. So good NFPs could result or favor then a push back towards at least the lows from yesterday, around 111.80 or something. So which means everything on the downside, there should be the overall mantra, let's call it, should be sell the bounce. And in this case, then the target for the days to come, for probably the weeks to come into the quarterly close, can be found around 109, 110, something in this region. But, and this is something definitely worth remembering, we can also see when looking at the so-called US dollar index future, you can see that we are about to push to the highest levels since 2017 here too. And now the thing is, we should all the time remember that Donald Trump is after a weaker US dollar. And so this is something worth remembering, because now with the US dollar gaining strength, especially against the euro, and mainly driven by the fact that the US dollar index future consists of a basket where the euro has a weight of 58%. So with this in mind, we should all the time be prepared for the days to come. And this is what I was referring to. When looking at the economic calendar, you can see, yes, there are some interesting events here. So for example, here next week on Tuesday, we have inflation, for example, very, very interesting number. Also Wednesday, we have the durable goods. We have on Friday, the Michigan consumer sentiment. So we can definitely say Monday already, retail sales. We can definitely say that the overall economic docket is packed. Nevertheless, the main driver will most of the time come from comments, especially from a political, respectively from a central bank perspective, in my opinion. Especially from a political standpoint, be aware that these current gains in the US dollar are definitely something, especially the White House, the Trump administration will look at with not sure whether it should be discussed, but nevertheless, it's definitely, they are skeptical about it. Let's put it that way. And so any comment here could result in sharp pushbacks in the US dollar, which are nevertheless not really sustainable moves, in my opinion, if they happen at all, and are probably interesting opportunities to sell the US dollar into them, or to buy the US dollar into it. That's that way around. So sell Euro USD into those pushes higher. Yeah, and again, so the first target on the downside can clearly be found then around 110, or lower, more aggressive is 109 around. So that's it on the Euro USD. So let's have a look, before we have a look here at dollar JPY, let's have a look here at pound sterling against the US dollar. It's very difficult right now, to be honest, to draw a picture here, due to the fact that I am more bullish in pound sterling. On the other hand, I know about the positive correlation between the euro and pound sterling, which means if you're very skeptical for the euro, you're going hand in hand with the skeptical outlook for pound sterling. And yeah, that said, I think it is really difficult because I really want to be long pound sterling in anticipation of a break higher above 33.50, 33.70, the region we now failed to break due to all those developments around the Brexit, which currently take on momentum. This is especially true when looking at the latest comments from last week, especially when Theresa May, the Prime Minister of the UK, started to become open for a delay of the Brexit deadline from the 29th of March, somewhere in the future. So there was no clear date mentioned. The same is true also, for example, for comments from the Labour Party chief, or is it, can we say that, Labour Party chief? So or the leader of the Labour Party, it's Corbyn, who also was becoming more open to potential second referendum, a second Brexit vote. So even if this does not take place, it does not necessarily, well, it usually results in optimism around an at least very, very soft Brexit we are about to see, if there is a Brexit at all. And usually this is positive for pound sterling. And those concessions made from the EU in this case are usually something which should usually favor gains from pound sterling on a broad front. And then in pound sterling against the US dollar, then an attack at 33.50, 33.70 here. So now, nevertheless, on the other hand, we have a very weak euro, which is also weighing on pound sterling then. So with this in mind, probably we should be a little careful with too aggressive long engagements. In a 4-hour chart, we are currently at least trading in a region against which long engagements could be favored. And by the way, especially against the US dollar, and if the non-farm payrolls today disappoint, this could be a first trigger. Nevertheless, if we drop back below 129.50, 129.60 here, then I definitely step back from short-term long engagements and pound sterling. On the other hand, the conservative approach could be, the aggressive one is buying into this dip now, into this region around 130.50 with a stop at 29.60, 29.50, so 100 pip stop, and then going for the attempt of a break higher, anticipate a break higher here of this red line, 33.50, 33.70. On the other hand, the more conservative approach would be to wait until pound sterling trades back above 31.80, 32, and then go long from here. Probably the to be favored and the conservative approach here, the to be favored approach due to the current weakness in the euro. So probably this is the most interesting way to trade pound sterling then. Wait till we make it back above 31.80 to 32. So yeah, that's it on pound sterling. The picture here hasn't significantly changed. Let's see what next week delivers in terms of, especially here, some numbers on balance of trade, but also here, the next parliamentary vote on the Brexit deal. Even though those votes in the past haven't really triggered any big volatility after the first vote here in February. Let's see if volatility is triggered or not. The day to watch here at pound sterling from this perspective surely is Tuesday. So now, after Brexit, after the ECB, let's have a look here at today's main event of the day. So non-farm payrolls, 1:30 p.m. London. And when looking at this event, then usually you also, and especially look at the yield markets, and here at yield sensitivity. Yeah, you know what I'm talking about. And there you usually look at the dollar JPY and also at gold. So usually you have a negative correlation between those two. So if one rises, the other should drop, and the other way around. So there was a very interesting, uncoupling, let's call it, over the last weeks, which we coupled back. That was last week on Friday when gold dropped aggressively below 1,300 US dollar per ounce, while dollar JPY nearly stabilized. So this decoupling then unfortunately didn't play out as we hoped to see it play out, because we've painted a quite skeptical picture about dollar JPY. Nevertheless, I'm still favoring dollar JPY to rather sooner or later see a drop. Probably in the morning, that was already the beginning, and we highly depend now not only on the non-farm payrolls, but also on the risk tolerance market participants are willing to take into the weekly close, due to some numbers which came in. Was it surprisingly? I'm not sure if this is a fair way to put it, but let's have a look here at today's export data from China. So these numbers, they came in minus 20.7% year on year. So export dropped over 20% here in February 2019, showing how highly fragile the current environment is, and how strong we depend on a trade deal between the US and China here. So, and this triggered not only losses in Asian equities here, especially the Shanghai Composite, for example, dropped more than 4%. The Nikkei in Japan dropped more than 2%, but it also triggered here a first short wave, let's call it, it wasn't even though short-lived risk aversion. JPY strengthened. We pushed slightly below 111. Nevertheless, we held 111, currently trading in the region of this lower trend channel here, of this upward channel. So now the question is, do we get to see a break today or not? I think we will get to see a break, especially if non-farm payrolls disappoint. This is also something we made a topic in our technical piece today. So on the website, admiralmarkets.com, you can go here to Analytics, Traders block, and then, let me, by the way, just close those tabs here. You can see here, this is the first article from today. Non-farm payrolls put the dollar JPY in focus going into the weekly close. If you click on it, you will see here that I, all in all, paint a quite positive picture due to the ADP data set, which came in quite solid on Wednesday. Well, we came in with only 183,000 workers hired in February. That was slightly below expectations. Nevertheless, so that was the expectation, 189. But nevertheless, we saw a quite aggressive upward revision here for the numbers of January, with 300,000 here, which is surprisingly strong, let's say. And so all in all, this points, while we know that ADP data set is usually a good indication for the non-farm payrolls, this is usually then an indication that probably also non-farm payrolls today will at least come in solid, probably surprise on the upside. So with this expectation then, and the current market environment after the data set from China overnight, we have to say, if here the numbers disappoint today, and it becomes very, very likely, and there you can see it here, we've seen the test of the region around 111 already here, that then if we go below that level, that further losses become likely and push us below 110.40 here in this case. So further losses become definitely an option. While, and this is something worth remembering, while we know about the positive correlation between gold and dollar, gold and the JPY, so the negative correlation between gold and dollar JPY. Saying that means dollar yen most likely goes down. If we drop below 111, this usually should indicate that gold should go higher here. And so far, we've seen already some gains in gold, which is definitely of interest and very positive, because we can, or we could hold a quite important region, in my opinion, around 1,275 to 1,277 US dollar per ounce. As long as we trade above that level, it's still an option that rather sooner than later we'll see a test of the region here of 1,360 USD per ounce. Let's probably a more conservative approach is, if data disappoints around the non-farm payrolls today, it's likely that we'll at least make it back towards, probably close the week above 1,300 USD, depending a little on how much risk aversion really hits the market then. On the other hand, if the data set comes in as expected, respectively, also an option, surprises on the upside, what gold bulls will hope for is that we do not push back below 1,275 to 1,277 USD. So this is the let's call it the small picture. The big picture usually contains also a fundamental perspective, and here the picture hasn't dramatically changed. In fact, it has brightened for gold long engagements. Why is that? This has to do with the fact that not only from a US dollar weakness perspective and the White House favoring a weaker US dollar, and especially after yesterday the ECB came out quite dovish, that the Trump administration will somehow counter with an intervention here, at least from a rhetoric perspective, which will push the US dollar lower and should push gold higher. But also something worth remembering, and that's something I mentioned also here in the technical piece. There were some comments already on Wednesday which shouldn't be underestimated. It's from the Fed of New York President John Williams, who delivered a speech here at the Economic Club of New York. That was on Wednesday again. And then he said during that speech that the Fed may consider, here is it, may consider negative rates and quantitative easing in case of an economic downturn, which is likely to come, by the way. So now it's on the table. QE4 is on the table, negative rates is on the table. And with this in mind, you can clearly understand what I'm talking about when I'm saying mid to long-term long engagements in gold are definitely to be favored, because another round of QE will definitely result in gold to significantly push higher, at least, or especially now also after the markets gave a first feedback here in regards of building distrust, or at least I feel it somehow, that market participants start to wonder whether the ECB still is in control of what's happening there from a monetary policy perspective. So when looking at yesterday's rate decision, you can definitely come to the conclusion that the markets start to wonder whether they're still in control of everything. And especially when looking at equities, it seems as if the picture has changed now, and that more liquidity is not necessarily resulting in more gains in equities then. And that's definitely something you should keep in mind and should remember when entering the markets also in the days to come. And yeah, so that's it from my end for today. I wish you a nice weekend. Enjoy yourself, and talk to you again then next week on the 15th of March 2019 with Admiral Markets Weekly Market Outlook then. Feel free to reach out to the website here, admiralmarkets.com, and check the section here below Analytics, the Traders Block section. So there are many articles, I think, which could be of high interest for active traders here. We are now started to also have or make so-called seasonal patterns a topic, something which is of high interest because I've painted a quite skeptical picture for the DAX, for example, with a potential drop towards 11,000 points. If you go to the Traders Block section and you look here at the latest strategic article around seasonal patterns, you will see that we not only made a bullish seasonal pattern for February a topic, which played out, okay, but also when scrolling at the end of the article, you can or you will wonder when will the DAX hit its next seasonal trend, and there between the 7th of March, so starting from today's closing price in the DAX here till April 3rd, you usually see, from a statistical standpoint, seasonal perspective, for the last 16 years, gains in the DAX in 12 out of 16 cases. So this is something which is completely countering what I just said in terms of the DAX, even though I have to say, I somehow have the feeling that this time the seasonality probably might not play out, but definitely something worth watching, and that's it for mine. So all the best. Talk to you next week again. Happy trading. Watch your stops. See you soon, and bye-bye.